Technical analysis is a scam. Just saying that out loud is enough to trigger most traders, and I understand why. For more than a century, technical analysis has been used by some of the most successful traders in market history, people who didn't just make money, but built legendary track records. Traders like Jesse Livermore, Mark Minervini, Paul Tudor Jones, Richard Dennis, Christian Kolamagi, Dan Zanger, Bruce Kovner, and Michael Marcus. They all used technical analysis, and many of them made tens or even hundreds of millions of dollars doing it. I use technical analysis. Many consistently profitable traders today still use it. So why would anyone argue that technical analysis is a scam? Because the truth is far more uncomfortable. Technical analysis itself still works. What doesn't work is how most traders understand it, apply it, and expect it to save them. And that misunderstanding is exactly why millions of traders lose money every year, despite using the same indicators, the same patterns, and the same strategies as the legends they admire. Almost every trader arrives at technical analysis the same way, not because of theory or academic finance, but because of proof. They see real traders with real track records. They read documented stories. They watch interviews. They study equity curves that actually happened. They see examples like Michael Marcus, who turned $30,000 into $80 million. Richard Dennis, who started with $1,600 and built it into $200 million. Christian Kolamagi, who grew $5,000 into $100 million. Dan Zanger, who turned $10,000 into $42 million in just 23 months. Mark Minervini, who transformed $30,000 into $72 million and won the U.S. Investing Championship twice. And Jesse Livermore, who famously turned $5 into $100 million, roughly $2 billion in today's dollars. Faced with evidence like this, the conclusion feels logical. If I learn their technical strategies and copy their setups, I should achieve similar results. But reality hits hard. Losses pile up, confidence collapses, accounts get blown. Same methods, radically different outcomes. So the real question becomes, if the strategies are public, why does success remain so rare? The biggest lie in trading is the belief that success comes from finding the right strategy. The perfect pattern, the best indicator, the mythical holy grail. Most traders spend years jumping from one setup to another, convinced that the next method will finally turn their results around. But real trading history tells a very different story. Technical analysis and strategy contribute only a small portion to long-term profitability, roughly 10%, not 50%, not even 30%. About 10%. The remaining 90% has little to do with patterns, indicators, or pinpoint entries. This is exactly why many traders can apply the same strategies used by legendary traders and still lose money, while those legends compound massive wealth. The difference is not the method itself. This misunderstanding is where most traders quietly fail. Most people assume legendary traders must have extraordinarily high win rates. They don't. In reality, many of the most successful traders in history operated with win rates below 50%, on average closer to 40%. And during difficult market environments, their win rate could drop toward 30%. Statistically, that's worse than flipping a coin, yet they still made millions. Another uncomfortable truth is this. Legendary traders didn't have the advantages most retail traders like to imagine. No insider information, no privileged access to Wall Street, no institutional edge or secret data feeds. They were independent traders, studying price charts, placing trades, taking losses, and learning from them, just like you. So if their success didn't come from hidden information, and it didn't come from high win rates, then the real question is this. What actually separated them from everyone else and turned them into legends?
This is the part most traders don't want to hear. The real edge in trading isn't a setup or an indicator. Roughly 90% of long-term success comes from two things: cutting losses quickly and letting profitable trades run as long as the market allows. That's it. No magic formulas, no complex models, just strict risk control and the emotional discipline to do the opposite of what feels comfortable under pressure.
In today's trading world, technical analysis has been heavily mythologized and widely misunderstood. Many traders treat chart patterns and indicators as if they're predictive tools, something that can forecast the future or guarantee profits. That belief is not only wrong, it's dangerous. Technical analysis does not increase your win rate, it does not guarantee profits, and it certainly does not predict what the market will do next. That's not its job. What technical analysis actually provides is far more limited, but also far more important: a clear entry and a clear stop loss. That is the full value of technical analysis. Nothing more, nothing less. Even though technical analysis may only account for roughly 10% of long-term trading success, under the right lens, it plays a critical role. Because without a clearly defined method, traders fall into the same destructive behaviors over and over again. They overtrade. They chase price after it's already moved. They trade emotionally instead of systematically. They move their stop losses when a trade goes against them, and eventually they refuse to take losses altogether. And emotional trading always ends the same way: losses. Technical analysis doesn't save traders from losing money, but it creates structure. It forces discipline. It defines risk before the trade is ever placed. Take the classic horizontal base breakout, a setup famously used by Dan Zanger. The logic is simple. Price consolidates in a well-defined range. The entry occurs when price breaks out of that range. If the setup fails, the stop loss is triggered when price falls back into the base. There's no prediction involved, only risk definition. You know exactly where you're wrong. Or consider the volatility contraction pattern, VCP, popularized by Mark Minervini. After a period of tightening volatility and decreasing price swings, the entry occurs on the breakout. If price fails to move as expected, the stop loss sits just below the entry candle. Again, the pattern doesn't increase the probability of winning. It simply defines risk in advance. This point needs to be emphasized clearly. Technical analysis does not raise win rates. Historical evidence shows that even legendary traders using these exact methods often operated with average win rates around 40%, and at times closer to 30%. What technical analysis truly offers is control. It provides a rational framework that prevents overtrading and emotional decision-making. The remaining 90% of trading success comes from what happens after the entry: cutting losses quickly and letting winners run long enough for the math to work in your favor. At its core, trading is a business, and every business, regardless of industry, operates under the same non-negotiable rule: revenue must be greater than expenses. If that equation doesn't work, nothing else matters. In trading terms, the formula is just as simple. Total profits must be greater than total losses. Everything else, setups, indicators, patterns, is secondary. Over a long enough trading career, the math tells the real story. If your total profits are roughly twice your total losses, you're already a trader who can survive and remain consistently profitable. When profits grow to 3 times losses, you've moved into the category of a skilled trader. At 4 to 6 times, you're operating at an elite level. And when total profits exceed losses by 7 times or more, you're competing with the top fraction of traders in the world.
Notice what this formula does not include. It doesn't mention a specific strategy. It doesn't require a high win rate. And it doesn't depend on finding better chart patterns. Success doesn't come from technical analysis itself, it comes from discipline. The discipline to cut losses without hesitation, and the patience to let winners run long enough for the math to work. This is why traders can faithfully apply the exact same methods used by legends and still lose money. Because without strict risk control, emotional restraint, and the ability to let winners run, even the best strategy collapses. Two quotes from Jesse Livermore summarize this reality perfectly. The difference between successful traders and unsuccessful traders is the ability to take a loss. And big money is made by sitting, not trading. That's the formula. Simple, unforgiving, and timeless.
If you want a trading framework built around what actually matters, risk control, discipline, and letting profits run, then this program is for you. On the screen right now, you're seeing real results from my students, traders who've gone from inconsistency to discipline, from emotional decision-making to structured execution. Many of them are now consistently profitable, have passed funding challenges, and manage capital with confidence, not because they found a magic strategy, but because they learned how to control risk and follow a process. In the past, students paid thousands of dollars to learn this system in live training. Today, I've decided to make the entire program available for almost nothing. You pay $25. That's not tuition, it's commitment. It's about taking this seriously. To be completely transparent, after YouTube's 30% cut and taxes, I barely receive anything from it. And no, I'm not making it free for one simple reason. When something costs nothing, people don't value it. When there's even a small investment, they show up, stay consistent, and actually do the work. $25 is the price of a couple of Starbucks drinks, but applied correctly, this framework can save you years of trial and error and potentially tens or even hundreds of thousands of dollars in avoidable trading losses. The door is open. The only question is, will you walk through it? You can join through the YouTube membership program or click the link in the video description to get started.